What is up, you guys? Nick here. If you're new, welcome. If you're returning, hey, hi, how are ya? It's almost Christmas Day, and regardless of which holiday traditions you recognize, or if you don't, I hope you are all doing very well. Thank you for the continued support throughout the year. It's been a long one, an arduous one, wild one, but here we are making it through and still putting the cards on the table. I love it. I will have a fun Christmas special out tomorrow, so make sure you subscribe. But in today's episode, I want to talk about some unique movements we're getting out of NIO camp and what's happening closing out the year. The end of the year is always a very interesting time for companies and the stock market alike. I want to focus on one thing in this video, and that is when, if, and how NIO becomes profitable. I see so many noobs on the internet just relentlessly pumping and cheerleading for NIO with virtually no experience or actual deep thought or analysis on the company. It's also hilarious seeing these people with extravagant, baseless price targets.
NIO to $200 a share, NIO to 1,000 by 2021.
NIO to $69 trillion per share.
I'm here for you guys, and in this video I want to take a deep analytical look at NIO's future quest in becoming profitable, when, if, and how this could potentially happen. Becoming profitable using an outsourcing model in the fierce and oversaturated EV space taking place in China is by no means easy, and it's important as long-term investors to take a look at this very carefully. We have a lot to get to in today's video, but first, Webull has improved their promo. They are now offering 4 free stocks worth up to $3,700. All you have to do is 1, sign up, 2, open an account, and 3, deposit in at least $100 using the link in my description. This is a complete no-brainer. Worst case scenario, you get the worst stocks, you're still getting like over a 20% ROI. Complete no-brainer. They are a 0% commissions trading platform, and in my opinion, they offer some of the best analytics in the game. This offer ends soon, don't sleep on it. If you haven't, make sure to hit that subscribe button. I do a ton of videos like this covering EV, tech, IPOs, and focus my investment strategy around innovative disruption. Decimate the like button while you're at it for Lieben, and without further ado, let's get right into it. Alright, so the main question on my mind and investors alike closing out the year is delivery figures. What is the potential of NIO to increase their sales when they're already pushing past their quoted capacity? To become profitable using an outsourcing model, companies have to theoretically output far more vehicles than they would having manufacturing all in-house. They obviously have to pay their affiliate plant partner a share of the proceeds. In NIO's case, if you didn't know this, they have a joint partnership program with JAC Motors. Other big vehicle company legacy brands also have affiliation with JAC, and they really are a powerhouse. Because NIO thus needs to win by the numbers, investors are minutely focused on their delivery capacity every single month. Throughout the course of this year, NIO has been in a constant arms race with supply and demand. Their demand far surpassed their supply, and chains in their supply web and sourcing were breaking left, right, and center. They had extremely early low forecasts heading into 2020 at the beginning of the year, as this coincided with the global health situation. However, we actually saw a massive recovery in mainland China's automotive sector that we hadn't seen in years. Many economists and analysts were actually shocked by this and had not prepared. NIO, having had low forecasts when they went into this frenzy, were constantly then trying to maintain higher outputs than they were equipped for. They recently pushed their JAC output capacity up from 4,000 to 5,000 in September. However, it quickly surpassed even this 5,000 mark, having delivered 5,055 October and 5,291 vehicles in November. This is indeed a feat for the company and shows their drive and relentlessness to show investors their future promise and capabilities. NIO is hopeful that they can extend this output to 7,500 units by early next year, yet have been widely quiet on this subject. I will have update videos the day news is released on this, so make sure to subscribe. They have also stated that they are hopeful of a 150,000 per year vehicle output at their plant within under 2 shifts. This is all very promising. Remember, if a company isn't profitable, then the company can't theoretically continue to exist for the long term. It's as simple as that. More and more companies these days are actually counterintuitively fine without being profitable, and investors don't seem to care whether a company is or isn't anymore. As so much venture capitalist money pours into non-profitable companies prior to IPOs in so-called hot sectors, they know that once the company does go public with or without profitability, investors will jump all over the stock and the VCs will get huge paydays. This is how venture capitalists make money. It doesn't matter whether or not the company's profitable, it matters whether or not the company is hot. The VCs are essentially just minimizing the amount these companies are losing and sort of artificially keeping these companies alive. Two recent IPOs like this come to mind, DoorDash and Airbnb. So although NIO is receiving lots of outsider funding and obviously a ton of investor interest, is this all warranted? They will need to become profitable before the well dries up. Is this possible? I want to talk about one concern and then one possible mitigation to their short-term quest in becoming profitable using an outsourcing model. I think this is best highlighted through their last 3 quarters. If you have been following NIO in the past few quarters or months, you would have known that they have drastically increased the revenue between Q1 into Q2, and then again from Q2 into Q3. This is good. In Q1, they generated about 1.37 billion in revenue, Q2, 3.72 billion, and Q3, 4.53 billion. Now let's look at their earnings in these same quarters. Q1, they lost 1.72 billion, but then after doubling the revenue into Q2, they lost 1.21 billion, which is nowhere close to a halving. And then the real threat, after then again increasing revenue by almost another billion, they were only able to lose 0.02 billion less than the previous quarter, losing 1.21 billion in Q2 and losing 1.19 billion in Q3. So we can see the discrepancy here, drastically increasing revenue and not really minimizing the loss of earnings. This was indeed a concern for many investors and analysts. Analysts want to see these earnings increasingly increase. And in NIO's case, this isn't happening yet. And that's the key word for me, yet. Let's focus on NIO's gross margins and vehicle margins. These have been increasing on an increasing basis. NIO, being positioned in luxury electric vehicles, also has to sell less vehicles than competitors as they simply cost more per unit. Their gross margins are up to 12.9%, up from 8.4%, which is really impressive. However, where is this gross margin coming from? Are investors asking this? Is it from lowering outsourcing, decreasing parts cost, better JAC streamlining? Well, partially all yes, but it is mostly attributed to an increase in cost in the average vehicle. I'm not sure how sustainable this increase in cost is moving into future quarters. The average NIO vehicle is sold for about 10,000 renminbi more than previously, and this is largely attributed to the increasing costs of their flagship SUV model, their first vehicle, the large ES8. However, it should be noted that these models are also decreasing in popularity over time, posting lower numbers for the 3rd straight month. However, this can also be attributed to the growing popularity of the EC6, their newest vehicle, so this fact should be taken with a grain of salt. Now, NIO realizes all these hurdles they face. They are aware of these, and they are mitigating these left, right, and center in my point of view. They have improved their supply webs and their outsourcing partners. Their cost of revenue and operating expenses quarter over quarter has remained largely stable, while, their total revenue grew faster. They have drastically increased their cash on hand, buying themselves plenty of time in the short term. Cash is no longer a short-term problem, which is very relieving as an investor, and they are the most robust in terms of financing of any EV Chinese startup. They are now in positive gross profit territory, which is also expanding QOQ. However, at their current trajectory, they would have to drastically increase the price of the vehicles, drastically sell tens of times more vehicles, or begin revolutionizing their supply chain to become profitable. Stephen Feng, NIO's CFO, declared that JAC Motors will cover most of the capital expenditure for capacity expansion, as they also have stake in this operation. This is very good news for NIO, as expanding is virtually costing little to no money. This is where the upside in an outsourcing model really comes into play. Let's also remember that NIO has other revenue sources. They are expecting NIO Power, a division of their company, to increasingly increase proportional share to their revenue and thus their bottom line, with prospects of expanding their battery swapping infrastructure to an additional 300 units across China next year. These stations eventually end up paying for themselves and then generating income. They currently cost about 2 million renminbi each to install. However, this number is expected to be cut in half as sourcing and construction becomes more streamlined. They are planning on slowing down their cash burn rate heading into next year, which will also start showing effect in their earnings. Remember, this hasn't yet been realized, and investors are still very bullish on this company. NIO's regulatory credits also come into play next year, which will add over $100 million to their bottom line. Now, I do think in closing this year, NIO will yet again be able to increase to all-time new highs in terms of deliveries into the month of December and January. This is always good news for their short-term share price. However, much of NIO's ability to increase in capacity is hindered on their supply chain partners, and this is where the primary kink in the system has been located. With Li Bin publicly stating that he hopes this is continued to be mitigated in the coming quarters, this is indeed promising. Customers have current wait times for vehicles up to a month and a half, 6 weeks. Li Bin has stated that he hopes this can be reduced to about 3 or 4 weeks' time very soon. Now, if demand is still much higher than the output, Li Bin has stated that JAC Motors will be able to reach 7,500 units of capacity in January, and with a quick rate of turnaround of 3 to 4 weeks, this would be massive for their delivery number and resultingly their share price. NIO's president Lee Hong-kin has stated that NIO will need to again more than double sales to even come close to becoming profitable. However, he has stated that he thinks this may become possible within about a 2-year time frame. Remember, NIO does have competitive advantages over other players in the space. Chinese subsidies will almost exclusively apply to their luxury electric vehicles, being more than 300,000 won, because they have removable batteries and their battery swap tech is pulling in a lot of investors and consumers. They hope to be able to expand rapidly into Europe, specifically Copenhagen, Denmark, and be able to deliver an additional 7,000 vehicles there in a 2-year time frame. They then expect to expand into, quote, Asian countries around China. I do think they will need to dominate and compete in the powerhouse EV countries like Norway and Germany. However, this is a fiercely competitive market, but I do think they need to get their foot in the door. So, I do think NIO will become profitable. However, there are short-term moves they must do now in order to see this happen. Investors can expect, in my opinion, high delivery figures for both December and moving into January. I do think we will see average share volumes really increase moving closer into NIO Day and their sedan revealing. There will be big movements within the share price. There will be a ton of volatility. I hope this sheds some actual analytical light on the matter, and I hope you gained some insight in this video. NIO to the moon as always. I will have updates moving into this extremely important time for this company, so make sure you subscribe. Don't forget about the Weeble promo for free stocks worth up to $3,700 for free. All you have to do is sign up, 2, open an account, and deposit in at least $100. You could sell the stocks if you don't like them. Worst case scenario, it's like a 20% ROI guaranteed. A no-brainer in my opinion. They have some of the best analytics in the game, and they are a 0% commissions trading platform. Anyways, everyone, I will see you all in the next video. Happy Christmas Eve, happy Hanukkah, happy holidays. See you in the next video. Happy trading, take care, and cheers.